Is Samsara or IOT stock the next Palantir? After all, management at Samsara does like to call out they have a lot of similarities, such as a $1.5 billion annualized recurring revenue, 30% plus growth, and a positive last 12-month free cash flow profile. And when you look at US listed software companies, there's only two that meet this profile, Samsara and Palantir. This is from their Investor Day presentation. And while Palantir stock is up over 500% this past year, Samsara stock, or IOT, is actually down around 5%, despite very similar financial profiles. High growth, significant recurring revenue, positive free cash flow. When I turn to Flash, my free AI assistant, feel free to check out the link below. It says that IoT has a lot of very, very valuable quality aspects, such as 10 out of 10 on revenue quality, with 98% of revenue recurring, with a high degree of retention, even selling, increasing selling, to the existing customer base. And we'll talk about that in a second. They also talk about a 9 out of 10 market position, being the pioneer and leader in this space, rapidly taking market share. So what do? When you understand what they're doing, they make the point that, look, you need to build the system of record for various different verticals. For example, for IT, you might have ServiceNow. For human capital management, you might have Workday. For customer relationship management, you have Salesforce. For creative, you might have Adobe. But for connected operations, physical operations, you might want Samsara or Samsara. That might be the new platform. And it has a lot of value, such as tracking your assets with telematics, safety, viewing what's going on with the assets themselves, tracking them, understanding how they're performing, and also providing visibility maybe on the site. So there's a lot of different angles in which Samsara is coming to the company saying, yeah, there's a lot of potential value proposition. For example, when you're looking at an asset, does it need maintenance or repair? Which equipment is being underutilized? If you, let's say, have a bunch of trucks, maybe they should go on a different route. Are there routes that might be more efficient? Can you change the risk profile for your drivers? Do some drivers have better or worse profiles? And so you have all sorts of questions. For example, should we transition to electric? Thinking about, the costs for your different assets. And so there's a lot of insights that you can get through Samsara. I do not own a stake at the time of this video. There's no incentive for me to make this video. I'm doing this purely out of the curiosity of this fast growing business, especially when you see a segment or a company say, yeah, we could be this pioneer in this space. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. If you enjoy educational investment videos, I do appreciate you hitting that thumbs up, hit that subscribe button. And so when I see what's going on with management, their value proposition, they call out, here's, one of the case studies where they're talking about working with Lanes Group and how their drivers are seeing a 25% reduction in severe speeding, a 92% reduction in mobile phone usage, and a 72% improvement in driver safety scores. So this is a combination of maybe being noticed that you're tracked, or maybe having some sort of camera in the asset that shows, okay, this is what you're doing. This is tracking your actual speed, and the drivers getting some sort of feedback. Oh, congratulations for 10 days, without speeding, or 100 days of safe driving. And this platform connecting the Internet of Things, hence the IoT name, has, this is IoT, Internet of Things. It has done exceptionally well over the last few years. You can see how this is an incredible chart, growing from just a couple of $100 million in ARR to around $1.5 billion, 30% plus growth. And management would argue they're just scratching the surface. In North America, roughly half the market, a little bit less, is penetrated, and Samsara has only a small amount. And this is for vehicle telematics. When you get into video-based safety, it's an even smaller percentage, only 10% penetrate. Then when you talk about Europe or the rest of the world, you're talking about even less. So a huge, headroom for future growth. And there's also the potential for upsales, because what might start off as a vehicle telematics solution could quickly turn into, well, maybe you want on-site cameras, or maybe you want cameras, looking at particular aspects. So this video-based safety or equipment monitoring. When does the red light go on? You need to change this part. And so there's a lot of different upsales that they're doing. This is why once they lock in their customer, they actually grow with their customers, not only as customers use the equipment with maybe more of their fleet, but then you also have these upsell elements. So nice retention, nice upsells. And so how does this go through my checklist? Because I run the same checklist no matter, if it's a big company, micro, this is true for me. It makes my life easier. But first, a quick plug. Recently, Neil Y wrote, I've immensely benefited from all your invaluable ideas and news thus far, and looking forward to more in the coming days. This follows Kieran D, who said, thanks so much, gave this service a try and was very impressed. Been investing 5 years now and haven't found anything comparable to what you're providing. So if you're looking for compelling ideas, come check out Unrivaled Investing. When I think about Samsara, this is the checklist: aligned management, compelling valuation, obvious growth potential, no blow-up risks, and a win-win value proposition, meaning the business wins, customers wins, the whole ecosystem wins. I think the win-win dynamic is fairly obvious, but we'll talk about it again some more. Aligned management, that's the most critical piece. And when I look at this ownership table, frankly, I love it. I like seeing Mark Andreessen on the table, a prominent venture capitalist. I also like seeing co-founders still own a huge slug of the business and effectively control the business. I mean, they own stakes in Samsara that are worth billions of dollars. That is the type of skin in the game that I love to see. I love seeing founders that are still doing this, saying, yeah, we not only control this business, we have a lot on the line to keep growing. And that 30% plus growth, by the way, does suggest they're rapidly taking market share and they are the leader in this space. So I like to see this aligned management. And it gets better, though, because when you look at Sanjit Biswas, co-founder of Samsara, he's been working with his partner Bickett, the other co-founder, and they previously co-founded a cloud networking company, Meraki. Apologies if I'm massacring the pronunciation, but that company was sold to Cisco in 2012 for $1.2 billion. So this is the formula I love to see, which is a serial entrepreneur with proven past success getting in the game again, because that hit ratio is very high, in my opinion. It's a great signal. And so when I see the co-founders doing it again, they don't need to do it. When you've had $1 billion plus exit, they don't need to do it. They're doing it because they see an opportunity and they want to work on it. And that's the difference between a mercenary and a missionary. So I do like to see this dynamic. This suggests these are missionaries. They got a ton of skin in the game. I like aligning myself with this type of management. So this aligned management just jumps off the table. I jumps off the chart. I love seeing it. When I think about the win-win dynamics, it's, as I already mentioned, it's fairly obvious. They talk about a universal return on investment. For example, if you have a fleet of trucks, all of a sudden you might have better fuel savings for routing and idling, noticing, hey, you might be idling your trucks over here, or, there are some drivers that are, maybe doing, bad routes. Also talking about lower insurance premiums if you have better driving, fewer accidents, fewer, on-road trouble. Less maintenance costs because maybe you catch a problem sooner, improving the asset utilization. It's so clear why this is a valuable, proposition for their customers. It just jumps out to me as well. And then talking about the opportunity, there's a lot, whether or not it's, scaling up a global fleet of assets to expanding into more end markets or cross-selling with various different products, whether or not it's the telematics to using video to maintenance. And so they believe there are still early innings in a connected fleet digitization, and that, the Internet of Things, this is just, you're talking about a multi-decade trend. And so this is something I do want to align myself with. The challenge is going back to that compelling valuation part, because I get the obvious growth potential. Blow-up risks, I think, are pretty minimal because they have, fairly significantly diversified customer base, lots of customers, lots of cash on their balance sheet. Clearly win-win. So everything that's sort of left is this compelling valuation for Samsara or IoT stock. When I look at Samsara, it's trading around 15 times price of sales. That in and of itself is not particularly cheap. You can see how the valuation multiple has come in a bit on a price of sales multiple from around 35 times to around 15 times. Personally, I prefer to find low single digits if I'm going to be looking at a fast grower, because this is arguably not cheap. I mean, back in the .com days, you had folks talk about how 10 times sales was ridiculously expensive. Obviously, businesses are different now. Companies are growing faster. they might have higher margin profiles long term, because, these are cloud-based type of companies. But overall, this is not a cheap multiple. However, once again, comparing it to Palantir, which is trading at 120 plus times price to sales, you might go, wow, this actually is potentially cheap. Now, I don't like that comparison, because what could happen is they could both get cheaper. You could have it go from 14 to 12 times, and Palantir can go from 120 to 12 or something crazy like that. So I think this is more a reflection that Palantir shareholders are drinking the crazy juice, and Samsara is trading at a full valuation. So then I'd want to dig deeper, because if you were to get the hype of Palantir with Samsara, given it has the growth, it has the shareholder base, it has the opportunity, it has the free cash flow, you do have that sort of lottery ticket potential that if enough folks wake up one day and say, hey, let's pump it up, you could have significant valuation expansion like you've seen with Palantir. A big part of the reason why Palantir stock is up so much is because investors are willing to pay more for valuation. Yes, fundamentals are growing, but the biggest part of their expansion is actually valuation, going from 10 times to 120 times. That can easily reverse, because investors should know that over a multi-decade perspective, valuation usually attributes zero to your long-term returns. Or very close to it. From a multi-decade perspective, thinking about the indices. For a company, valuation can change a bit, but this type of valuation expansion, this has a huge red light looking at Palantir. But could you have that sort of, maybe it turns into a benefit for Samsara or not? So I want to dig deeper, thinking about the business, around $20 billion market cap, growing around 25-30% this year. They have around 77-80% gross margins. Currently not really profitable. So I'm going to make a large assumption, assuming that they get to that, let's say 25% operating margins. They are positive free cash flow, but it's just not quite there yet. And then the question is, over the next 5 years, what does their revenue look like? And I'm assuming compounding at 15 to 25%. Maybe my 15% is too low. And I'm assuming because the high degree of retention, you're at 25 to 35 times earnings. Either way, looking at this business, it's just, this framework doesn't scream out as deeply compelling. I called out just this past week how one of my top holdings has a profile that I'd argue looks much better than this, even though it's not in the sexy space of Internet of Things. It's more like, around 100% in the base and closer to 150% in the bull, and I'm looking to add on weakness. And so I think there's, for something like this, it wouldn't surprise me if it doesn't go anywhere for years. Maybe it does, but I look at this and it's an example of, I'm very interested in this. Maybe I consider some sort of very small teaser position because it has that really strong management alignment, growth, a lot of attractive fundamentals, but I just can't get there on the valuation perspective. If you think I'm missing something big about Samsara or the opportunity, I'd absolutely love to hear it in your comments below. I hope this video has been helpful for you. Thanks so much for watching Unrivaled Investing.